Imagine two people. Both earn the same salary. Both are 25 years old. Both have the ability to save $500 every month. The first person says $500 isn't enough to make me rich, so they never invest. The second person quietly invests that same amount every single month. No excitement, no market predictions, no complicated strategies, just consistency. Fast forward 30 years. One person wonders where all the money went. The other has built a portfolio worth over $1 million. How? Did they discover a secret investment? Did they take huge risks? Did they get lucky? Not necessarily, because this story isn't about finding the perfect investment. It's about understanding one of the most powerful financial systems ever created, compounding. Today we're going to follow the journey of a single $500 monthly investment and watch how small decisions quietly become extraordinary results. Let's be honest, when people hear $500 per month, most aren't impressed. Some think, that won't change my life. Others say, I'll invest once I can afford more. It feels too small because our brains naturally focus on immediate results. Imagine planting a tiny seed. After 1 week, nothing appears. After 1 month, almost nothing. Most people give up before the tree ever has a chance to grow. Investing feels exactly the same. Small in the beginning, powerful much later. Let's begin. You invest $500. After 1 month, you own about $500 worth of investments. Nothing dramatic happened. No millionaire, no Lamborghini, no financial freedom. Which is exactly why many beginners quit. They're judging investing by weeks, instead of decades. But investing isn't designed to impress you immediately. It's designed to reward patience. Now let's speed things up. You continue investing, $500 every month. You never skip. You never panic during market declines. You simply stay consistent. After 5 years, you've personally invested $30,000, assuming an average annual return of around 10%. Your portfolio is now worth approximately $39,000. Notice something. Nearly $9,000 came from growth. Your money has started working. For the first time, your investments are helping you invest. Now another 5 years pass, you continue investing. No changes, no excitement, just consistency. Total contributions, $60,000. Portfolio value, approximately $103,000. Now something interesting happens. You finally cross 6 figures. People begin noticing. Friends ask, when did you become interested in investing? The funny part, nothing changed. You simply refused to stop. The portfolio looks impressive today because of decisions made 10 years ago. Now, this is where investing becomes fascinating. Imagine your portfolio grows 10%. If your investments are worth $100,000, a 10% increase adds roughly $10,000 without you working another hour, without asking your employer for a raise, without starting another side hustle. Your investments begin producing more money than your monthly contributions. This is the moment many investors wait years to experience, because eventually, your money begins working harder than you do. Let's continue. 20 years, you've invested $120,000, but thanks to compounding, your portfolio is now worth approximately $380,000. Notice something surprising. You contributed less than 1/3 of the portfolio's value. The majority came from growth. This completely changes your relationship with money. You're no longer building wealth alone. Time has joined your team. Now let's reach the destination. 30 years. Monthly investment, $500. Average annual return, 10%. Your total contributions, $180,000. Portfolio value, approximately $1.13 million. Read that again. You invested $180,000, but your investments generated nearly $950,000. The majority of the wealth wasn't created by your paycheck. It was created by time. This is why people often say the first million is the hardest, because once compounding reaches scale, the mathematics begin looking almost unbelievable. Now let's compare two people. Investor A starts at 25, Investor B starts at 35. Both invest exactly $500 every month. Both earn identical returns. Both stop investing at retirement. Who finishes with more? Investor A, not because they invested dramatically more, because they gave compounding an additional decade. Those extra years become the most valuable investment they ever made. Time isn't just another variable, it's the multiplier behind every other variable. People often ask, which stock should I buy? What ETF should I choose? When should I invest? Those questions matter, but they aren't usually the biggest reason people succeed. Most successful investors simply stay invested. Through crashes, through recessions, through uncertainty, because markets rise, markets fall. But history shows that long-term investing has rewarded patience far more often than prediction. Consistency beats perfection, almost every time. Here's what this video was never really about. It wasn't about $500, it was about systems. Imagine automatically investing every month, whether you feel motivated or not, whether the news is optimistic or terrifying, whether markets are rising or falling. Eventually, the habit becomes more valuable than motivation, because habits survive the days when motivation disappears, and wealth is usually built on ordinary days, not extraordinary ones. If there's one thing I'd like you to remember from this video, it's this. Most people dramatically underestimate what small amounts of money can become, given enough time. $500 doesn't look life-changing today, but consistency transforms ordinary amounts into extraordinary outcomes. Not overnight, not next year, but gradually, quietly, almost invisibly, until one day, you look back and realize that the most powerful financial decision you ever made was simply refusing to stop. I'm Morgan Vals. Build small, grow strong, live free, and I'll see you in the next video.